Well, okay, let's go ahead and get started today. We have 4 modules to go to like we always do. And as always, I will be recording this and we'll send you the slides and the recording later after the webinar today. If you have any questions as we go along, by all means type them into the question box you see here below, and we'll stop from time to time and answer those questions as well. So the first of our 4 modules today, this is a 4-week series. We are the 3rd week into it. We have one more week next week. And today we have 4 modules, and the first one's called the follow-up. And this is really crucial when you do the follow-up for after the pitch session. And most people focus on the actual pitch or the preparation, but I think the follow-up is actually the key success factor for those who actually raise money or don't raise money. And most entrepreneurs really get into the pitch, but the most important step is actually the follow-up that comes afterwards. And the follow-up starts in the pitch. So after you pitch to an investor, either in a formal setting or an informal setting, you always ask the investor if you can keep them informed of your progress with periodic updates. And I don't like to promise weekly, monthly, or otherwise. I just say from time to time I'll send you updates. And then you adjust the frequency based on having good news to share with the investor. And in some cases there are deals that can send something out every week and it would be meaningful. And there are others that send out something every quarter. And that's about as often as things are happening. And so what you want to do is take the investor that you've pitched to who is a prospect. They've not invested yet, but they're just thinking about it, and you place them on an investor prospect list just like you would a potential customer. You're putting a prospect on the list that you're going to continue to talk to till they sign up to buy your product. Well, we're doing the same thing here, but with investors. And then from then on, you decide how often, but you need to send them a regular communication with an update on your progress itself. And what we're trying to do is make it a very short 2 to 3 paragraph email describing your progress. If an investor ever opens up an email and sees a 5,000 word block of text, I guarantee you they're not reading that. They're skipping it and will tell themselves they'll do it later. And as we all know, later means never. So you got to make it short. 2 to 3 paragraphs is all you need to explain what progress you're making in your deal. And so the 5 areas you want to talk about are, number 1, the product, how you're doing with developing the product, adding features, getting it finalized, getting the bugs out, getting it available to ship, or if it's shipping, improving it. Number 2, generating leads. This is marketing. What are we doing to get more interest in our product? Number 3, sales, which is contacting customers, how the customers are shaping up, what the pipeline looks like, what customers are buying, how much that's adding up to be, and so forth. And then number 4 is building out the team. And the team can include not only the key people you hire, but also channel partners, sales partners, things that may be going with the web if that's a key part of your sales progress as well. And the 5th one that's not listed here is the intellectual property. If you have any office actions, if you filed any patents, if anything is happening on the intellectual property front, these are the things you want to talk about as well. Now, what you don't spend too much time talking about are things that you don't control. The growth of the market, the competition, etc. And that's because investors want to hear about what you are doing. They want to know what progress you are making and what milestones you are hitting, and it's all about your execution. It's not about the landscape in which you're operating. It's about the accomplishments that you are making, because this is the part that they're watching to see how well you execute on. And then the key is to show you are on track with your plan and achieving milestones on a timely basis. In 2 or 3 paragraphs, you really can't get down to every little detail about hitting forecasts or being a little bit behind or whatever. I don't worry about that. I keep it at a fairly high level, but also succinct level, showing how you're making progress. Make sure you customize these communications, and they're mostly emails, so they address the investor directly. You don't want to say, "Dear all." You don't want to say, "Dear investor." You want to say, "Jim," or or Mary or Susan or Sam. You want to make sure that you're making that as personalized as you can. I often get communications from entrepreneurs who I can tell have just put me on their PR list, and I'm getting the same thing that every newspaper or magazine editor is getting as well, and it's completely inappropriate. I'm an investor, not an editor. I want different kinds of information. I want to know how the business is doing. I don't want to know just about new products that have launched. In fact, I should, as an investor, should know about that months before it launches, so I'm understanding what's going on in the business. And so you want to treat the investor as a special person getting special information as well. And as I said before, just don't add them to your general database and send them PRs. Make sure that you show them that you know an investor is a separate class, gets a separate set of information, and is not just another customer. Next one is every month you should be setting the goal to add 10 more investor names to your investor prospect list. Through networking, through pitch sessions, through referrals, you should be taking people and asking permission to keep them updated after you've given them some information about your company. In some cases, you've sent them an exec summary. Other cases, you've gone out and actually talked to them. Other cases, you've actually pitched to them. But you have the contact details, and you're able to put them on a prospect list. And our goal is to put 10 names on the list every month. And after 5 or 6 months, you should have 50, 60 names on the list. And we're trying to get up to 60 names as quick as we can, because then the monthly communications will be going to more people, and we'll be educating more people with those emails that we're doing on a monthly basis. As you get feedback from the investors, as you hear questions, as you see people expressing interest, you move some of those investors to the top of the list. You don't just send them down somewhere in the middle. You start to prioritize the investors you think are the most likely prospects to do something, and you move them to the top of the list. And from time to time, you want to reach back out to them and set up another coffee to go back and re-engage with them, check back in with them to see what they think, and to keep working them. And the goal is to get 10 to 15% of these investor prospects communicating with you on a regular basis, and you're building a relationship with them so that they're understanding better the deal and they're getting more comfortable with it. And then you're learning more about the investor. What can the investor bring to the table aside from just dollars? Do they have a Rolodex? Do they have a network of other people? Do they have expertise in an area that can help you as well? And what you want to do is set up a meeting with those who responded, and at some point you want to just ask again for funding. I'm still looking for funding. Are you ready to invest? And at some point, it is common to have 5 or 6 people who are expressing interest in investing in your deal, but no one wants to go first. And so what we have to do is go back to the pool of interested investors and start looking for what we call a lead investor, and make sure that we highlight the benefits that we can give to the one who goes first. And it's often the case that you have to do something a little bit, give them something better or some incentive for them to become the lead investor, because there is additional work, there is additional risk. The lead investor could be the only investor, and that can be very difficult for them as well. So the key here is you want to start looking for that lead investor from the investor prospects. And over time, what you'll find is that 10% of your investor prospects will put your deal under serious consideration and will come out and will seriously consider writing a check. Sometimes all 10% do. Sometimes not all 10% end up writing the check. But that's why we have to put these people on a list and continue to update them, is you're looking for those who are going to bubble up into that top 10% role. So let's stop for a moment and see what questions you have there. That may be a lot of information to take in all at once, but what we're trying to do is show that is more than just going out and pitching investors and then waiting by the phone for them to call. There is a proactive job you have in keeping them up to date and sending them regular communications. And there's really nothing too magic about the communications except that they are giving people an update about what you're doing and reminding them that you're still there, you're still working on the project, and you're still making good progress as well. So the first question up is, how often should I send out my communication? And my response to that is, if you were to sit down and write 2 to 3 paragraphs, how often can you do that? yes, you can write one now, but can you write one again next week? With most entrepreneurs, the answer is no. You need about another month or 6 weeks before you have another meaningful couple of paragraphs, and you don't have to cover all the topics every time. You can cover just 2 or 3 topics and just highlight what's going on well there in that case, and then putting that out. I have had some entrepreneurs that like to email every week, and it's just 1 or 2 items, but it's spread over a very lengthy page of an email, and I tried to get them to condense it back down. And so I'd set a goal at once a month and see how that's working, and then you can make that longer or shorter as you need it. If there are any other questions, I don't see any right now, but if there are any other questions, feel free to type those in as we go through the slides. So let's look at the next section here. It's called Understanding the Deal from the Investor's Perspective. And I get this question a lot from entrepreneurs. In particular, the entrepreneur goes in and pitches the deal, and he's all excited about it, and then the investor comes back and he just rains on the parade. He's a wet blanket. He doesn't get it. You know, he's not with me. He's not sharing the excitement. And many entrepreneurs, especially first-time entrepreneurs, are not prepared for that. They're excited about the deal. They see all of the opportunity, and they in many cases, their enthusiasm is infectious, and that's all great and good. But it doesn't always translate onto the investor side, and they come to me asking, what did they do that's wrong? And the answer is they didn't do anything wrong. It's just that the entrepreneur and the investor are both looking at the same deal, but they come up with very different views because they're coming at it from a very different place. And so the entrepreneur view is he's looking at the opportunity in the deal. He sees the customers building up. He sees the capabilities of the product. He sees how far ahead of the competition he is. He knows he's in a good place, and so he's really excited about this because he's seeing the opportunity that's in front of him. He's got customers asking for the product. There's potential revenue on the table. The market is growing fast, and it's just a great opportunity. The investor, on the other hand, is coming at it from a different angle. The investor is looking at the risk in the deal. What happens, for example, if the team doesn't work well together? What happens if the sales forecast isn't met? What if the customer is not happy with the product itself? What if the price point is wrong? What if the competition is stronger than we thought? These are the questions that come up that the investor is going to be looking at, and while they're not trying to poke holes in the deal, they are wondering what happens if those things happen. And so that's why the investor view and the entrepreneur view are not going to jive together, and people end up looking at the same deal and not coming up with the same answer. And so what do you do about this, or what does the entrepreneur do about this? Well, the first one is, you go through and examine the risk at each point in your pitch, and then show how you mitigate that risk. So what if the team doesn't work well together? What if that is a potential risk? Well, then go in your slides and in your presentation show how the team has worked well already and how well aligned they are. What if the sales forecast isn't met? Well, then show your track record with your forecasts in the past, showing that in every quarter for the last 7 quarters, we have met forecasts. We are very good about this. We have put these systems into place to give us an accurate forecast. Or what if the customer is not happy with the product? We'll go back through and show how the customers are already happy with it, and you have a 98% success rate, and the 2% that are not happy, we were able to work out something with them. And so the idea is you find the risks that are in your deal, and before the investor brings it up, show how you've mitigated those risks and assuage their fears and take it off the table to some level. So in summary, the entrepreneur is looking at the possibilities, the investor sees the risks and the challenges, and to raise funding, you need to be able to take the risk off the table itself that goes in there. So let's stop and see what questions people have at this point. Those who have raised funding in the past probably know what this is all about. You've actually gone out and you've talked to investors and then found out they came back without much interest, and you're wondering why, given it seems like such a good opportunity itself. And so part of it is they're coming at it from the angle of what if, and part of it is, in many cases, they're still trying to figure out what is the deal all about, and they're taking it in still, and some people take things in faster than other people. First question is it a good idea to share investor Q&A with other potential investors? And I think the answer is yes. You can take questions that have come up with other investors and pose it as a question and then give it as an answer, because as you go forward you'll get questions and have come up with an answer, and it's always a good idea to work those into the presentation because other investors will have the same question as well. So I think that's a good idea, and of course spin it in a positive way, showing how you've got a solution for any of the questions that come up. And then how do you get the group of potential investors is another question. And as we talked about last week, there's several ways to find potential investors. Number one is you go to your attorney and you ask for potential investors. Two is you leverage your network. Everyone on the team should be putting in 10 names of potential investors that we can go talk to and pitch and put on the investor prospect list. Number three, we should be getting out to pitch sessions. There are free and paid pitch sessions around the area, and we need to be out there talking to these guys, pitching them, making sure that we're building up that list as well. And there's other things like business plan competitions and the like, where investors hang out, and through networking you can find more investor names. And the idea is to find 10 a month, that's one every other day, that you can either talk to on the phone or talk in person and explain what you're doing, and then invite to put on the schedule as well. What other questions do we have out there at this point? Okay, well, let's move on and look at the next section. If you find a question coming up, by all means, let's spend some time on it. The next section, we're going to spend a little bit more time on it because I think it's an important point for a lot of people. And the question is how to set a valuation for your startup. If you've never done a startup before, you are probably looking and asking yourself, well, I wonder what my company is worth. I wonder what investors think my company is worth. And so let's talk about that a little bit, and I'll give you a methodology you can use. Before I give you the methodology, let me say that it is a negotiation. It is not a formula. In the end, no matter what number you put on the table, you must negotiate that with the investor, and you must convince the investor that's the right number. And to the extent that you can back up your valuation or proposed valuation, you'll be more successful at the negotiations process itself. So what we're doing here in setting a valuation is that most startups are giving up equity in order to take on the funding, and the question will come up is how much equity or ownership are we going to need to give to the investors for the money that's coming in. And so the ownership is called equity, and what are they going to get for that is what we're trying to come up with. And when we say valuation, we're talking about what is the company worth before the money goes in, and that is what's called pre-money valuation. After the money goes in, that's called a post-money valuation. So when you talk to investors about valuation, make clear which one of those you're talking about. Now, the challenge we get into is that traditional financial models that are used in valuing companies, such as discounted cash flows, book values, asset values, simply don't apply to early stage companies. The company is early on. They, in many cases, don't have revenue. They don't have much of a cash stream. They certainly don't have too much in the way of assets, and to simply use that as a mechanism can undervalue your company a great deal and doesn't really reflect the value that's in your company as well. So if you're an early stage company without significant cash flows and value, the value in your business is really in four areas. It's in the intellectual property that's attached to the company. It's in the team. It's in the products, and it's in the revenue model. And the business model is the product and the revenue together that we have out there. And so the way you set a value for your company is that you go out and we use the rule of 4. And the rule of 4 is for every one of the following, give yourself a $1 million valuation if you have it in a full and complete form today. One thing to say about valuation is it's what's in the company today. It's not what's in the company tomorrow. It's not what will be there next year. It's what's there right now. And the value is set right now, which is why when people come to me, they want to raise $1 million and they don't have any product or revenue working, I discourage them from trying to raise $1 million because their valuation today is very low. Next year, it could be better. And so let's move a good portion of the raise to next year when you have a better valuation on your business itself. But the management team, the product, the customers, and the intellectual property are the 4 key elements that we're looking at. And so if you were to give yourself $1 million for each of these 4 things, and again we're talking about early stage companies, you're just going to market, or you've just been in the market, or you haven't been to the market, we're going to use this methodology. As you get later stage and you have predictable revenue streams and you have a growing customer base and you've got IP that's been signed off, well then you could think about using the more traditional values to value your business, but most people are not in that place just yet. So let's take the management team as a first case. For example, if you have hired in place the full management team, all the C-level people are in place, everybody's working, everything is going fine, everybody knows what they're doing, and each of them have substantial industry experience, and then give yourself a valuation of $1 million for the team. And that's 3 or 4 C-level people that have been hired in place on the team. Now, if you don't have all 3 or 4 level people in place that you envision for the company, maybe you only have yourself and half time of another person, well then give yourself a lesser valuation. Maybe you give yourself $300,000 because you only have 1.5 of the team hired, not all 3 or 4 people hired. And it's a judgment call as to how much you put onto it, but at least now we have a range of 0 to $1 million, and based on how many people, we're going to have some portion of that for our valuation. The next is the product. If the product is complete, it's full-featured, it's shipping with the bugs all worked out, and it's what you expect it to be, and it's what the customer expects it to be, then give yourself a valuation of $1 million. It's often the case the product is not complete. It's in beta. It's not requires more work, and it requires more development to get the features into it that you want. And maybe you give yourself $500,000 or $400,000 because you have a working beta and not a fully shipping product itself. So again, we're going from 0 to $1 million, and we're giving ourselves some credit for what we have developed so far. The next one is the customer. If you have 10 large customers and they're buying your product every month, they're repeat customers, they're reoccurring customers or reoccurring revenue customers, and go ahead and give yourself a valuation of $1 million. If, on the other hand, you have only a handful of small companies and some of them have bought, but others are just considering to buy your product, and some are in various stages, and some haven't considered to buy in a repeating fashion, well then give yourself $250,000 or $300,000 if you are in that state. Again, it's a judgment call where you go in the 0 to $1 million, but you start to get the idea here that as it's a continuum, and as you make progress in each of these 4 areas, your valuation should go up by a certain amount. And when we go to investors, we're taking these talking points with them about what values are in the business, and we're listing that out as a backup for what we're trying to do here. And the fourth one is the intellectual property. So if you have all your patents filed and all of them are awarded and everything is finished, then give yourself a valuation of $1 million for the IP. If you have filed but not received any office actions, they've not come back and said anything about it, well then give yourself maybe more $150,000 to $200,000 for it. And as you get office actions and as you get the patents awarded, you can increase that to a higher level. So what you simply do is now add up all 4 of those elements to give yourself a starting point for a discussion with the investor. Notice I didn't say you get your valuation. The valuation only comes when the investor agrees to it. But as I said before, no matter what you put on the table, the investor is going to say, how did you arrive at that? And the reality is most entrepreneurs come up with a valuation based on how much they want to own at the end of the process. They figure out based on what they're raising and how much they want to own at the end of maybe several rounds of fundraising, and then they work the math backwards to what should the company be worth today, and then they put that in front of the investor to see if that's going to fly. And for some investors that may fly, but for most investors it does not, and when they ask that magic question, how did you arrive at that, you can put some numbers on the table, and maybe there's some fine-tuning that goes on to it, but hopefully you and the investor are now in the same ballpark and we're not too far away from an agreement that goes into it as well. So, remember the investor is motivated to have the valuation as low as possible, so the entrepreneur is trying to get it as high as possible. For those, so let's see what questions people have. Okay, the first question that comes up is, what is pre-money? What is a pre-money valuation? So pre-money is what is the company worth before you put money into it. So the idea is, let's say the pre-money valuation is $4 million, and you as an entrepreneur are trying to raise $1 million. So 1 plus 4 gives you a post-money valuation of $5 million, a pre-money of 4. The investor is going to get, if they put in $1 million under that negotiation, they're going to get 1 divided by the post-money. Their investment divided by the post-money is what ownership they get, so 1 divided by 5 means that they get 20% of the company. Now let's take another case. What if the company is worth $19 million pre-money? You're raising $1 million. Post-money is $20 million. The ownership is 1 divided by $20 million, or 5%. So in this scenario, if you were able to negotiate a pre-money valuation of 19, you're only giving up 5% of the company instead of 20% of the company. I will tell you that most companies are in giving up the 20 to 40% range for their startup is where most of them are coming out to be, given that they're very early on. They don't have much. Many of the values very well progressed in any of the 4 areas. They have some, and of course you want to get credit for some, but they don't have that much. But most are in the 20 to 40% range right now. And so the first question is how far apart is too far? And when we have entrepreneurs that are coming in saying they're worth $10 million and the investor thinks they're worth 1.5, that's too far apart. We're not going to be able to get close that gap anytime soon, and the chance of that coming to a conclusion is probably not going to be very good. If we're within $1 million or $2 million on the valuation, then typically the entrepreneur and the investor find a way to close the gap, and they come together on it. So there are no initial valuations above $4 million. Well, I'm going to be focusing on the very early stage companies, and for early stage companies that are raising funding today, and that means you are just going to market or just about to get into market, I've rarely seen companies worth more than $4 million to investors. Investors will just see too many risks of the product not selling, the product not working, the team not working well together, the intellectual property not being signed off. And most companies just don't have everything rolling. If they did have everything rolling, $4 million for going to market companies would still be a pretty good valuation. But you are correct, we are capping it at $4 million. And I watch entrepreneurs come in and pitch to angel groups, and they don't have a product, they don't have revenue, and they spend their time trying to convince investors that they're worth $10 million. And most investors are simply not going to sign up for $10 million. In fact, most angel investors are not signing up for anything above $5 million. So it just helps us get all into the same ballpark if we use the rule of 4 and we come together. And it's another question. If you knew you could only get a $4 million valuation at best out of your deal, would you still want to raise money? And many entrepreneurs decide to do the bootstrap thing instead because they feel like they're going to give up too much money or too much equity for the money that they bring in. Can you explain the equation to get to percent of equity that entrepreneur has to give up again? And so the equation is you take the equity piece you have to give up is the investment you're raising divided by the post-money. So pre-money is what the company's worth without the investment. Post-money is what the company's worth with the investment. So in our $4 million pre-money company, raising $1 million of funding, giving us a $5 million post-money valuation, $1 million investment divided by $5 million post-money gives us a 20% equity that you would be giving up for the $1 million. And I can point you to some resources, and we can talk offline if you'd like to have a little bit more clarity about pre-money and post-money. And it's something you should know before you engage investors, because they will be asking these questions, and you should have some idea of what your answer is, as opposed to let me get back to you. You should have some thought about what portion of the company you're willing to give up, what range you might be in, and then when you go into negotiations, you can actually show you put some thought into it. But the key is to have something backing up your valuation. You've actually thought through the values of your company. You can physically point to the values of the company. It's not something that's future. It's something there today, and that's a key thing. Most entrepreneurs keep talking to me about what they're going to do next year, and they want to base the valuation on next year, but they want the money now. And that's just not on with investors. Investors are going to invest in what's there today. So what is the difference in valuation for value-added versus companies that develop products? And again, I think it goes back to what is the product that you're developing. How far is it into the process itself? And a value add is typically there's a product or service there as well. And even if it's a service, it's the same thing. How complete is this service? How developed is it? How much is it being sold out there for? How much is the intellectual property around it? So all of these same equation items reflect into a value-added service as well as an end-user product itself. And so you have to look at your piece of it. It's often the case that what people are selling is solving one piece of a bigger problem itself. We're not solving everybody's problem with one product all by itself. And so we have to put some boundaries around it to actually say, well, how complete is this itself? And we can talk more about that offline if that's not enough detail for what we're doing here today. Again, if there are any other questions, go and type them in, and let's move on to the next section here in our presentation. And so this is our fourth piece, which is called Working with Angel Investors. And I bring it up because entrepreneurs come to me often trying to get an understanding of what an angel investor is like. And the first thing I tell them is that the angels come in all forms, shapes, sizes, and types. You'll see every kind of personality. You'll see every kind of investor type out there. I invest in teams. I invest in products. I invest in the market. I invest in the execution. I invest in whatever. And you'll find that the entire gamut will be covered. If you go out there long enough, you'll see just about everything. And their criteria varies dramatically as well. What resonates with one investor does not resonate with another investor. And then the other thing you'll find is that they have different levels of contribution, everywhere from being able to do nothing but write a check to being able to do everything. And of course, you want the guy that can do more than write a check, who can contribute to your business as well. And then their motivation to invest often varies as well. Someone once said an angel investor wants to do a little good, make a little money, and have a little fun. And in general, I think that describes a lot of angel investors. But what you'll find is that there's some people that have a greater give back contribution. There are others that it is just about the return and nothing else. There are others that it's a family and friends, it's a relationship building thing, and there's a big component of investing for that reason as well. So what you'll find also with angel investors is that some are very experienced in the fundraising process, but that most or many are not experienced with the process. And don't be surprised when you get in front of an angel or angel group and you find that people are really excited and they want to do this, but they don't know what the next step is. And they're not moving forward because they don't know what the next step is. Where do we go from here? And so if you get into a situation where you have a group of angels, but they're interested but not knowledgeable enough about, well, you need to do due diligence and negotiate terms and set valuation and move forward with it, you may have to step in or have somebody step in and coach or herd the cats, so to speak, to guide them through the process. And so don't be surprised if you come across someone ready to write a check, but aside from signing the check, they don't know that you have to sign investor documents. They should be doing some due diligence on this. They should be checking with other people on this as well. The other thing to make clear on is that even today, investors, angel investors, you need to make sure that they are accredited investors. About half the angels I meet have never heard of the accredited investor criteria. They see their buddies out investing in startups and they think they can as well, and in many cases they are accredited investors. But the fundamental question, and there's many ways to become an accredited investor, but the standard basic one is an individual who has a net worth that's over $1 million, not counting the house that they live in. You can't count your primary residence anymore. But those rules were set quite some time ago, and they really haven't changed in a long time, except with the Frank Dodd Act of a couple of years ago. So what we're trying to do here is make sure that any investor that expresses interest in your deal is an accredited investor. And most good attorneys are going to require them to sign a letter stating that they are an accredited investor. And so when you get family and friends coming in and they're expressing interest and so forth, at some point you need to deal with the fact, are they accredited or are they not? If you Google Accredited Investor Security Exchange Commission, you'll find the link that describes the accredited investor criteria in mind-numbing detail. It's all there on the website itself. The other thing I always like to bring up when you go out to work with angels is that in most cases, angels are not going to be experts in your industry. And that's one reason why we talked about a follow-up process where you're sending regular communications. Those regular emails you send every month can be very helpful in organizing and educating the angel on your industry. What are the dynamics? What are the cycles? What are the seasons? Who are the players? Who are the competitors? And in your communications, you can add a paragraph or two about the industry, about the dynamics, because part of your interest here is trying to get the investor up the curve on your deal, understanding better what's going on there, and it takes some time. And it's a lengthy process, but it's worth doing at the end of the day so that angels know something about it. But when they come in, you do not assume that they know your industry, the technology, or the players very well. So as you rattle off names of big customers and big competitors, that often falls flat with angels because they don't have a sense of who they are or why they should care about that. So we want to be able to educate them as we go through this process. As I said before, you can treat angels as herding the cats. It's often the case you'll have 5 or 6 angels that are interested in a deal, but no one wants to lead the deal, and you have to put in processes to herd them along. And so a couple of things you can do in this direction is, one, organize, schedule follow-up meetings and invite all interested investors to it at one time. That'll save you time, and the investors can come to the room and meet other investors they may not have met before. They can share information, and I think overall it gives them a sense of confidence that they're not the only one in this deal. So one thing you can do from a pitch session is just tell the audience, okay, we're pitching here on Wednesday of this week. On Wednesday of next week at this time from 2 to 3 p.m., we're going to have a follow-up meeting in our office. We invite everyone to come to our office in our 2 to 3 o'clock meeting next week, and we'll have a demo. Everybody's invited, and you'll meet other people as well. And you get to ask any questions you want, and that'll save you a lot of time. And if you get 5, 6, 10 angels coming out to see a demo all at one time, I think it would give them, in many cases, it gives them confidence that they're going to be in with other people. They can share information, they can share due diligence and info, and oftentimes that's very helpful to you because you're taking some of the risk off the table. In this case, the risk that they're going to be the only investor in the deal when they come to those as well. And so The other advantage is it reduces the number of meetings you can do. If you could do one meeting for 15 as opposed to 10 meetings for 2 each or 1.5 each, it'll save you quite a bit of time as well. So herding the cats is part of the process, and it's something that we can do out there. It's not uncommon to get several angels coming together but no one wanting to lead the deal. As I said a few moments ago, we're going to have to do something to incentivize one of the investors to be the lead investor. And so the first step in closing angel money is to get a lead investor, and the lead, for those who are not familiar with it, is the first one to write a check. The first check that goes in that is setting the terms. Sometimes you'll get an investor that wants to write a small check, but they don't want to set the terms, and you can take that money, put it under a convertible note, not have to deal with all the details of valuation or negotiation or whatever, and so there's money there, but they haven't set the terms. When I talk about a lead investor, I want someone that's going to actually come in and set equity financing terms, and we want someone that's going to set the terms on what we call investment-friendly terms. And the investors often incentivized to do this as well. They're trying to come up with terms that will get other investors to come into it. If a lead investor comes in and signs up investor unfriendly terms, well then they are hurting themselves because they're going to be preventing other people from coming in and filling out the route. And that's something most lead investors worry about is, will I be the only one that's signing up for this, or will there be other people that come in with me? And so you want to make sure that they come up with investor-friendly terms to go through it. The other thing is the lead investor typically does some initial due diligence. I mean, most of this documentation is coming from you, and so you're packaging it up to help them, but they're reviewing it, they're asking questions, you're capturing that information, you're capturing the answers into a package, so to speak, that you can then hand follow-on investors later, that you can say, well, the lead investor looked at this due diligence material and wrote a check on it. Here's the due diligence package. I'm going to hand that over to you as well. And you then want to make that available to everybody, so you want to keep track of this packet because other investors will want to see it as well. So after you sign up the lead investor, they've written the check, they've got the first money in, they've got the basic documents signed as far as subscription agreement, valuation set, etc. Then you go to the other investors and say, we have the lead investor, the terms are set, you send them the documents in your monthly communications, and if your lead investor has name recognition, that helps even more, but you'll find that many follow-on investors will start to invest once the lead is done because the heavy lifting has now been taken away. Basic due diligence has been done, basic legal work has been done, initial money is in, and the risk that this won't get off the ground is dropping dramatically now because you now have traction with investors. So in summary, you'll need to educate the angel investor, and there's ways of reducing the follow-up process by having follow-up scheduling meetings. You're going to have to work with a variety of people that goes into this process who have different or conflicting motivations to invest, but in many cases that's okay. One can invest for the goodness of their heart, others can invest for return on investment, and when you pitch your business, you want to make sure that you touch on all the values so that you connect with any interest that might be in the room as well. Along the way, you're going to need to find a lead investor and recruit one to become one. Often what you'll need to do is give additional incentive to a lead investor. I've had several lead investors not go through the process because they felt like, well, I could go do 40 hours of work, I could pay the legal fees, sign up the documentation, I could write a $100K check, and then the next guy comes along, writes a $100K check, and he gets the exact same equity that I get. I don't like that. And the answer is, well, we'll give you extra warrants. We'll give you extra stock options. We'll give you a compensated board seat. So you want to think along the lines of how can we compensate a lead investor for going first and for doing this extra work that other guys following on don't get compensated for because they did not do that work. And that more than anything holds back lead investors is the fact that I'm doing this work and I'm not getting paid for it. And if you can find a way to compensate them for doing that work, and it is work, it's 20, 30, 40 hours of work they have to go through to sign this deal up, that you'll find it knocks down that barrier and gets going to the next level. So the question is, what do you mean by equity finance terms? So when you sign up a term sheet, you're putting in there how much the company is worth? What is the valuation? How much equity is going to the investors for the money that's coming in for this round? How much other terms are going to be set in there, such as liquidation preference, information rights, subscription rights, and there's just a number of different terms that come into a term sheet that can be modified by the investor. Again, it's a negotiation between the investor and the entrepreneur, but you want to have what would be considered terms that other investors would find attractive. And so the idea is to come up with a negotiation that is fair to the entrepreneur, but is also going to be friendly to investors and encourage them to sign up as well. And we'll talk next week about the terms. There are over 125 potential terms that can go into a term sheet, and we're going to break that down into a more meaningful set next week. At some point, you should talk to your attorney about terms and what is commonly used out there and what is important for you to know. Before you go into a negotiation for terms, you should certainly educate yourself on the major ones so that you can talk intelligently about them, know what the investor is considering or thinking, and be able to react. I've been in negotiations with entrepreneurs. I've been on the investor side, and in one deal I had the investor say we want 2x liquidation preference. And the entrepreneur leaned over to his attorney and said, so what does that mean? Well, in a negotiation, now is not the good time to be educating yourself. You should come to the table knowing a little bit about what that is before you get to the table. And then a fair question is, what do you think about that? And negotiating, having your attorney help you. But basic education should be passed at that point. What other questions do we have at this point? What kind of terms go into a term sheet? Well, there's four kinds of terms that we'll review next week, and let's save the terms for next week because there's quite a bit that goes into it. We've covered quite a bit of information today. Are there any other questions on today's information? So a question comes up is back to communicating with investors. What about sending them a regular message through the mail? Oh, you mean like postal mail, I guess. Okay. Yes, you can write out these updates and send them by postal mail. I myself have never been impressed by getting letters in the mailbox out in front of my house. Some people in the networking world believe that that shows great time and care and consideration, but I myself have just not put a lot of value behind that. I guess I'm more of a content guy. It's the content of your message and not how long it's taking you to write it out or what format you send it to. So I'm not a big fan of the postal box. Primarily because I see people spending a lot of time trying to get those physical addresses. When you have their email address, just use the email and spend some time on the email to make that a more compelling presentation, short, to the point, meaningful information, answering questions directly, etc. Tends to do more for me than the actual writing it out into a physical letter. That looks like it's all for the questions for now. Like I said before, we will package up the recording and package up the slides and send it out to you guys. If you would like to talk offline, by all means drop me an email back and let's set up a time and let's go through any questions that you have that are specific about your deal that don't fit into this. And if you have concerns or want to know how you do things like how you source investors and so forth as we had today, we can brainstorm a little bit more about how we might do that. So that's all we have for today. I don't see any other questions here, but like always, we're available to answer and talk with you. So let's go ahead and close it out for now, and you guys have a great weekend, and we'll talk to you next week.